Yeah, it might sound a little bit exaggerated, but if you look back at history, silver has always been the money of the people. It has been like taken away or demonetized since the mid to late 60s in most Western countries. But I think that if you look back at 1980 and 2011, you had two major crises there. The first one was the dollar crisis. As some people probably don't remember. I don't remember it, but I've read about it that in the late 70s, like 78 and 79, the U.S. Treasury issued what they called Carter bonds. They were U.S. treasuries denominated in Swiss francs and Deutschmarks because no one wanted dollars. So yeah, in 1980, January 1980, yes, the Hunt brothers did try to corner the market eventually, and the regulators stepped in and stopped people from going long silver, and it stopped that speculative move in silver up to 50. But Paul Volcker was the chairman of the Federal Reserve, and I've read that he's commented after the event that there were some brokerage houses that were in trouble that could have gone under. It could have brought probably the whole banking system under, and eventually, he had to allow short-term rates to go to 20% a few months later, or back in 81, 10-year treasury yields rose up to 15.5%. So yeah, I think silver was like the canary in the coal mine, so to speak. And in 2011 as well, when we almost touched 50, that was right at the beginning of the sovereign debt crisis in Europe, of the PIGS, which was an acronym for Portugal, Italy, Ireland, Greece, and Spain. And eventually, in the summer of 2012, Mario Draghi, the president of the ECB, he came out and said, we're going to do whatever it takes to save the euro and stop this sovereign debt crisis from spreading. And whatever it takes, of course, was money printing. It wasn't raising rates like Paul Volcker did in 1980, because nowadays, Elijah, there's so much debt in the system that you can't raise rates anymore to solve a crisis. You've got to cut and print more.
Then what does this mean for the financial system if we see silver spiking again, really signaling a crisis, but we can't raise rates to the necessary levels that would solve the issue if the debt is so high?
Yeah, that's the problem nowadays. The debt is so high. Raising rates doesn't solve anything. They raised rates in the 80s to bring back investors into the dollar. They did that in 1992 here in the UK as well. When the pound collapsed, they raised rates to try to attract investors. They reversed those hikes very quickly. But nowadays, the system is so leveraged that they have to keep. Well, they'll have to cut or print more. And what a move towards 50 or even above 50 in silver, which I think is highly possible, would signal as a crisis, I don't know.
There's something almost poetic about silver. It's like the underdog of the monetary metals. Quiet, underestimated, and then suddenly explosive. If gold is the king, silver's the scrappy prince hiding in the alley with a knife in its boot. People laugh at silver until it stabs the financial system in the ribs. You know, it might sound a little exaggerated to say silver is signaling a coming financial reckoning, but if you look at history, every time it spikes, there's a crisis lurking. Silver has always been the money of the people, usable, divisible, universal. And ever since they demonetized it in the 60s and kicked it out of the monetary system, they've been trying to suppress it like an embarrassing secret. But the thing about secrets, they tend to get out eventually. In January 1980, silver reached $50 an ounce. People remember the Hunt brothers trying to corner the market, but what they often forget is the context. That was a time of absolute chaos for the US dollar. In the late 70s, nobody wanted dollars. Imagine that, so little trust in the greenback that the US Treasury had to issue Carter bonds denominated in Swiss francs and Deutsche Marks. That's not just a bad look, it's financial surrender. The Hunt brothers didn't trigger that crisis. They were the symptom, not the disease. Silver was already flashing red. It was the canary in the coal mine. Paul Volcker, who gets credited for saving the dollar, had to jack short-term rates to 20%. That's not a minor policy tweak. That's a full-blown monetary sledgehammer. The 10-year Treasury yield hit 15.5%. And let me tell you, that didn't happen because everything was going well. It happened because the whole banking system was about to fall into the abyss. Fast forward to 2011. Silver, again, climbs toward $50. And what's happening in the background? Europe is imploding. The so-called PIIGS nations, Portugal, Italy, Ireland, Greece, and Spain, were buried under mountains of unpayable debt. That acronym might sound cute, but it was anything but. You had riots in the streets, bond yields spiking, and serious talk of the euro collapsing. And just as silver approached that psychologically critical $50 mark again, the European Central Bank steps in. Mario Draghi gives us the infamous whatever it takes speech in 2012. That was the signal to unleash the monetary floodgates. But unlike Volcker, Draghi didn't raise rates, he printed. Because the system now, decades later, is so deeply in debt that raising rates becomes financial suicide. There's no more Paul Volcker-style fix. The only tool left in the box is the printer. That brings us to today. Here we are, again, watching silver start to climb. It's quietly defying the paper markets that have been trying to beat it into submission for decades. Silver's been manipulated through what Eric Sprott rightly called the COMEX LBMA exchange for physical doom loop. And yes, it's as sinister as it sounds. It's a shell game where they sell paper contracts representing silver that doesn't actually exist, just to keep the price suppressed. That suppression has worked for a long time. But cracks are forming. The COMEX open interest in silver has been dropping. That tells you people are losing faith in the paper system. More are demanding physical, and guess where that physical is going? It's not staying in the West. It's going east. India, China, Russia. Countries that have been accumulating gold are now quietly hoarding silver. Maybe they see the writing on the wall. Let me tell you, when silver demand really hits, it won't come from Wall Street. It'll come from the people who know what real money looks like. When the manipulation stops working, the market will snap like a coiled spring. We're already seeing evidence of that. In the past, a massive sell order on COMEX could knock silver down for days, weeks even. Now, the market eats it and bounces right back. That's new. That's important. The price suppression game is losing its power. You'd see one of those 1,000 contract dumps in the middle of the night. No seller in their right mind would execute a real order like that. I used to work as a futures and options broker for government bonds. If you had a big order, you'd work it slowly. You don't just crash it into the market unless you're trying to trigger stops. And that's what they've been doing. Triggering stop-loss orders just below key levels, like 34.95 if silver's hovering near $35. It's market manipulation, plain and simple. They trigger the stops, let the market cascade lower, then cover on the other side, rinse and repeat. But lately, it's not working like it used to.
I think the above ground inventory, you're making, excuse me, it's more profitable right now to scrap silver because the price is going up, but I still think it's not really that great. So that's going to push things even higher because, the deficits that the market has been running in silver, that will be negated in years, not in months, because there's not too many primary silver producers, and to start producing silver takes time. You as a silver mining explorer, it takes years to drill for the silver and then to get all the permits and everything, and then you've got the political risks like in Mexico. Yeah, Mexico is a big producer of silver. I saw recently that their government are not going to issue new licenses for I think it's open pit mining, or it could, yeah. So, yeah. The other thing, it takes a few years after you drill for the silver. You got to build the plant and then start processing. Taking it out of the ground. It takes 3, 4, 5 years. So yeah, the prospects, fundamentals are still good, supply and demand for silver. And on the other hand, I think silver has been capped down through the infinite amount of paper that the COMEX and LBMA create via their, it's called, I think Eric Young called it the COMEX LBMA exchange for the physical doom loop. And I think that's coming under pressure. So that will drive the price higher as well, because they're not really trading real physical silver there. They're trading paper, and eventually when people really need the physical, they're going to have to cover their shorts.
In the past, but it seems like now we're seeing a lot of strength in the market, even when we see these hits by people who might be, trying to manipulate the market.
Yeah, it looks like the silver market has got a lot more depth in the past. I think it was last week they did that. It would have driven the market lower, and it would have stayed there for maybe days or weeks. And it was only a matter of an hour. The market came right back. And I worked as a futures and options broker for government bonds. I did trade a bit of commodities, gold and silver as well. But if I got an order from a client, a big order, the client usually used to tell me, please, I'll leave you the order and you work it, because it's a big order. So I would sell a little bit every 10 minutes or so. I wouldn't go into the market and just dump everything, because I'm trying to get the best price. So yeah, I agree. You see a lot of that, unfortunately, and I've been seeing that for over 20 years in gold and silver futures.
I sometimes wonder if silver isn't the most misunderstood asset in all of finance. It's almost like it's been purposefully hidden from the average investor, demonetized, ridiculed, sidelined, only to come roaring back when crises hit. And this isn't some romantic fantasy. It's happened twice in living memory. January 1980 and April 2011. In both cases, silver spiked near $50, and in both cases, it was a fire alarm for the financial system. Let's go back to 1980 for a moment. Everyone remembers the Hunt brothers trying to corner the silver market. But what people forget is the context. We weren't just dealing with a speculative frenzy. The dollar itself was in a tailspin. Inflation was raging, investors were fleeing the greenback, and the U.S. Treasury had to do something absolutely extraordinary: issue so-called Carter bonds. These were U.S. government bonds denominated in foreign currencies, Deutschmarks and Swiss francs. Imagine that today, the United States having to beg the world for capital in someone else's money. That's how bad it was. And while people point fingers at the Hunts, the truth is that silver was acting like the canary in the coal mine. Paul Volcker, the then chair of the Fed, later admitted that brokerage houses were on the verge of collapse. If the silver price hadn't been suppressed by emergency margin hikes and regulatory intervention, the banking system could have gone under. Fast forward to 2011, another silver spike, another crisis, this time the European sovereign debt debacle, the infamous PIGS, Portugal, Ireland, Greece, Spain. You remember those headlines. Greece was basically defaulting, and the contagion risk had the Eurozone on edge. Then ECB President Mario Draghi comes out and drops the whatever it takes bombshell. And just like that, the crisis is papered over. Not solved, mind you, just deferred with a fresh torrent of liquidity. So what does that tell you? When silver starts to take off, it usually means something deeper is unraveling. Not in a linear way, of course. You don't get a neat, tidy correlation like in a textbook, but it's a pattern, and if you've been around the markets long enough, you start to see these patterns repeat. And here we are again. Only this time, the situation is far more precarious. Why? Because the system is even more leveraged. In the 1980s, the US debt to GDP ratio was under 40%. Today, it's well over 120%. In Japan, try 250%. The idea that you can raise interest rates to stabilize your currency or attract capital is now laughable. If rates go to 20% today, you blow up the whole economy. You trigger defaults, bankruptcies, social unrest. It's game over. And yet, silver is beginning to stir. We just broke through $35 million levels not seen in nearly 14 years. That's not just some random tick. That's a tectonic move. The $35 resistance level was tested earlier this year and rejected, but now it's broken. And anyone familiar with technical analysis knows what that means. It opens the door to $40, $45, even $50 in short order. Richard Dennis, the famous commodities trader from the 1980s, developed what's known as the turtle trading system. The idea is simple. When an asset breaks out of a long-term price range, say a 55-day high or low, it often continues in that direction. And folks, silver just broke out of a 14-year range. This isn't noise. This is a signal. You can already see the reaction from momentum traders, hedge funds, even retail. Everyone is starting to wake up to silver. And as I like to say, silver doesn't move slowly. It explodes. It sleeps for a decade and then tries to cram a decade's worth of gains into a few months. Now, of course, the usual suspects are trying to fight the move. Bullion banks, swap dealers, call them what you like. They're heavily short. They're doing their best to cap the price. We've seen some aggressive selling, sharp intraday drops. But the difference now is that the dips are being bought. The paper attacks don't stick. The physical buyers, especially in Asia, are hoovering up everything. Just look at the SLVETF. A few days ago, Bob Coleman pointed out that some of the bullion banks couldn't borrow shares to short it. That's huge. It means supply is drying up, even on the synthetic side. Meanwhile, inventories at the LBMA are being drained at an alarming rate. We're down to 155 million ounces. That might sound like a lot, but in the context of global demand, especially for industrial applications, it's a drop in the bucket. Let's not forget, silver is not just money. It's also an industrial metal, a critical one. Solar panels, electric vehicles, 5G infrastructure, water purification, you name it, silver is in it. It's the most conductive metal on Earth. Try electrifying the global economy without it. And yet, new silver production is barely keeping pace with demand. The deficit we've been running for years is not being filled. Mexico, one of the world's biggest silver producers, is now restricting new mining permits. Political risk is rising, environmental regulations are tightening, and developing a new silver mine takes years, if not a decade. From exploration to permitting to construction, it's a long, expensive process. And that brings us to Japan. What's happening in the Japanese bond market is nothing short of extraordinary. For years, Japan had near zero or even negative interest rates. But in the last 18 months, their 10-year bond yield has gone from 0% to 1.6%. The 30-year and 40-year bonds are now over 3%. That might not sound dramatic, but in a country where debt to GDP is 250%, it's a nuclear-level event. Add to that the fact that rice prices, yes, rice, have doubled in the past year. In Japan, that's like bread doubling in the US. It's a staple. Inflation is very real, and the Bank of Japan is stuck. They can't raise rates aggressively without bankrupting the government. But they can't cut rates either because inflation is still running hot. This is the same trap every major central bank is in. Raise rates and you trigger a debt crisis. Cut rates and you unleash more inflation. There's no painless way out, and that's why silver is so important, because silver is the barometer. It's the one asset that tells the truth when everything else is being manipulated. When the Fed lies, when the ECB prints, when the BOJ monetizes, you can bury that truth in the headlines, but silver eventually screams it out loud. We are at a turning point. Physical metal is being drained, paper manipulation is failing, technical resistance has been shattered, industrial demand is rising, central banks are cornered, and now the public is starting to notice. Let me share a final anecdote. I recently spoke to a silver wholesaler in Germany. He told me demand is now so strong that they're limiting purchases. Not because they want to, but because they can't source enough product. They've had to double their lead times and premiums are creeping up every week. He told me flat out, "Mario, this is different. It feels like the beginning of something big." And I agree. This time it is different. Because unlike 1980 or 2011, there's no Volcker waiting in the wings with 20% interest rates. There's no fiscal room to issue foreign-denominated debt. There's no credibility left in the institutions. The tools have been used, the bullets have been fired, the curtain has been pulled back. So what can you do? Own silver. Own it physically. Own it before the panic. Stacking isn't just a hobby anymore. It's a form of resistance. It's a vote against debt, against fraud, against the fiat Ponzi. It's opting out of a system that punishes savers and rewards speculators. It's taking your wealth off-grid where it belongs. Silver is the money of the people, always has been, and in this coming storm, it will be again. You can ignore silver, but it won't ignore you. Stay strong, stay awake, and as always, keep stacking.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.